Welcome back to the deep dive. Right off the bat, I'm going to say this session is heavily inspired by the thinking, the worldview, and the recorded insights of the late Charlie Munger, especially on rational behavior and, well, financial success.
Definitely. His framework is crucial here.
And we're really trying to cut through the noise today, tackle a question that's, frankly, a bit uncomfortable.
Which is?
Why most people? Why they never actually become wealthy?
Yeah, it's a big one. And it's an essential mission, I think, but it needs a very specific lens. We have to look past the usual suspects, you know?
Like what? Market timing, the economy.
Right, or even specific stocks you pick. The material we've looked at, Munger's ideas, they argue that if you really want to understand financial failure, you got to stop looking outside.
Yeah, it means stop blaming Wall Street or the government.
Exactly. You need to start looking inward, examining the biggest obstacle there is, the human mind itself.
Okay, let's unpack that. There's this huge irony, right? Our sources hammer this home. People spend their whole lives chasing money.
Obsessively sometimes.
Excessively, yeah. But they never really bother to understand how wealth is actually created. It's like they work harder, complain louder about the system being rigged.
Oh, you hear that all the time.
And they definitely envy deeper. But they're playing a game that feels rigged, and the sources say the rigging is, well, it's all internal. It's in their heads.
That's the absolute core thesis here, and it forces you to completely redefine wealth, or at least how you get it.
So it's not luck, not just being smart.
Well, luck helps, intelligence helps, obviously, but they're not the deciding factor, not according to this framework. Wealth is framed more as simply a byproduct.
A byproduct of what?
Of rational behavior. But here's the kicker. Rational behavior sustained over decades.
Sustained rational behavior. Okay, that sounds almost deceptively simple. Like anyone could do it.
It sounds simple.
But it highlights exactly where most people fail consistently.
Yeah.
It's the same reason diets fail or New Year's resolutions, right?
Pretty much. People just, they can't sit still. They can't stand being bored. And they find it incredibly hard to think independently away from what the crowd is doing or saying.
So they choose noise over actual knowledge.
Yes. They trade substance for speed. They prioritize the constant chatter over real understanding. And they definitely chase that immediate pleasure, that quick hit, over long-term principle. They get seduced.
Seduced by shortcuts.
Instantly. And sometimes that seduction is permanent. It sets a pattern.
And if you trace that back, the average person, they don't usually lose their financial footing because of some huge market crash necessarily, or even getting bad advice from a planner.
Although those things can happen, sure.
Right. But the core failure, it's their own impulses, that burning desire to get rich quick.
That's the single greatest guarantee you won't get rich. It's paradoxical.
That urgency, that craving for instant results.
Yeah.
It's like the silent killer of compounding. It just strangles it before it can even start working.
You know, money is kind of the ultimate mirror. It just reflects our internal state. If you're disorganized in life, volatile, impatient, guess what? Your finances will probably look pretty similar.
Chaotic.
Chaotic, yeah. But if you're disciplined, maybe even a bit boring and patient, your wealth, over time, it starts to reflect that steady, compounding discipline.
That distinction is crucial. Okay, so our deep dive today is really about dissecting that internal psychological machinery, the stuff that stops us, stops most people from actually adopting and sticking with that rational behavior.
Exactly. And maybe we should start with how people even perceive the path to wealth itself.
Okay, so every generation, it seems like we repeat this pattern. The sources call it the foolish cycle.
Yeah.
You look back.
Railway mania in the 1800s.
Yeah, or the oil booms, dot-com bubble in the 90s, the housing crisis, crypto more recently.
Always something new.
Always. New tech, new ways to invest, new promises flying around about effortless money, instant riches. It's the same story, different flavor.
But underneath that shiny new technology, the constant factor, it's always human psychology. It hasn't changed.
Greed, envy.
Greed, envy, and that fundamental inability to just wait, to delay gratification. Every time some new wave of excitement hits the market, these basic human drives just get amplified.
And they overwhelm everything else, even smart people.
Oh yeah, they overwhelm technical knowledge, they swamp common sense. Even people who are incredibly intelligent in other parts of their lives get caught up.
Which brings us to this great paradox about actually building wealth, the path. It isn't hidden, is it?
Not at all. It's not some secret formula locked away in a vault or some complex algorithm only math PhDs can run.
It's accessible to pretty much anyone.
It is. It just looks, well, incredibly boring.
Boring. That's the key word.
And that boredom, you could say, is its defense mechanism. It's the moat protecting it from the impatient crowd.
Hmm.
We have to really ask, what does real sustainable wealth building actually look like day to day?
Not exciting, I'm guessing.
Definitely not exciting. It looks like patience. Patience that honestly borders on inertia sometimes. It looks like years, literal years, not months, of just consistent, kind of dull saving.
Plugging away.
Plugging away, consistent, probably unchanging investing, and just letting compounding do its thing silently, almost invisibly for a long time in the background, while everyone else is chasing the next big thrill.
Okay, but I got to push back a little. If the path is that simple, that available, why don't more people take it? Why does almost everyone seem to reject it? Why is the shortcut always so much more appealing?
Because I think if you sat the average person down and told them the cold, hard truth,
Which is?
that financial independence is built slowly,
Yeah.
consistently, through hundreds, maybe thousands of small, rational, often tedious decisions repeated over, say, 20 or 30 years.
They'd tune out immediately.
Immediately, their eyes would glaze over. We're hardwired, it seems, to look for that dramatic feedback loop, that instant win. People would genuinely rather believe in some kind of magic formula than in basic math and time.
They mistake excitement for progress.
Perfectly put. The moment you find yourself seeking excitement in your financial life, looking for that sudden jackpot, you've already stopped being rational. You're not investing anymore.
You're looking for a rush, a stimulant.
You're looking for a high-risk gamble, not a long-term strategy. You want the thrill, not the foundation.
And this is where the irony comes in, rewarding the few who can stomach the boredom.
Exactly. The boring path works precisely because so few people are willing or able to take it. The system, whether you call it the market or just the mathematics of compounding, it's inherently structured to reward those who can just sit still, emotionally still.
So discipline itself becomes this huge advantage, an edge available to anyone, basically,
Yeah.
regardless of how much money they start with.
Absolutely. Think about it. If 90% of people were patient investors, patience wouldn't be an advantage anymore, would it? It'd be the baseline.
Right.
But because the vast majority are constantly chasing action, noise, drama, simple discipline becomes a powerful strategic asset. The market rewards it, kind of like nature rewards adaptation.
How so?
It happens quietly, there's no applause, no big announcement. Often, the reward only becomes obvious after a really long time, after what feels like tiny incremental changes. It's almost like financial survival of the fittest, meaning the most emotionally stable.
That's a powerful way to frame it. Okay, so we've established this external view.
Yeah.
The path is boring, but effective because it's boring. Now, let's go internal. Let's dissect the psychological gears that stop people from sticking to that quiet discipline.
Where do we start?
Let's start with what feels like the defining issue of our time, the cult of impatience. It's impossible to ignore, isn't it?
Yeah.
We live in an age that doesn't just allow instant gratification, it practically demands it, validates it.
It's the default setting now.
We've got these supercomputers in our pockets,
Yeah.
instant communication, endless entertainment on demand, immediate social validation through likes, retweets.
Constant feedback loops.
Exactly. So did any wonder people expect instant wealth, or at least really rapid wealth? It feels psychologically
Yeah.
logical in a way.
It feels logical to us, but the economy, the market, fundamentally, it operates on much older physics. You know, the physics of accumulation, momentum. It doesn't run on human psychology.
The market just doesn't care how urgent you feel.
Not one bit. The economy doesn't bend itself to fit your shrinking attention span. And that clash, that fundamental mismatch between our high-speed expectations and the, frankly, glacial pace of real wealth building, that's where so many rational long-term plans just get shredded.
Okay, let's focus on the actual damage impatience does. Structurally, it's the direct enemy of compounding, right?
Absolutely. Compounding starts so agonizingly slow. The first few years, maybe 5, 7 years, the returns barely seem to register. It feels like nothing's happening.
Which requires massive patience, like monumental patience.
Right. But what do people do? They're checking their portfolios daily, hourly sometimes. They're confusing short-term market noise, volatility with actual meaningful progress or lack thereof.
Let's move beyond just the analogies, though. You mentioned the plant analogy earlier, pulling it up to check the roots.
Right. It kills the plant.
But what's the real financial cost? Let's talk dollars and cents, or rather, lost dollars. When impatience forces you to act, what happens?
Okay, 2 big things, typically. First, the obvious one, transaction costs. Every time you buy or sell, there are Fees, spreads, maybe commissions, they seem small, but they add up, especially if you're churning your account.
Okay, friction costs. What's the second?
The second is often far more damaging: tax inefficiency. This is huge. If you sell an asset you've held for less than a year, here in the US, for instance, any gain is usually taxed as short-term capital gains.
Which is taxed at your ordinary income rate.
Exactly, which is often much, much higher than the preferential long-term capital gains rate you get for holding over a year. So you're literally paying a premium, call it an impatience tax, just to lock in a small gain quickly. You're destroying the long-term efficiency of your own portfolio just because you couldn't wait.
So that farmer analogy, the farmer who keeps eating his seeds, he's not just losing the potential crop from that seed.
He's paying higher taxes on the tiny bit he chewed off.
Wow. Okay. And what about the other side? Selling winners too early, or constantly switching strategies.
That's just as bad, maybe worse in the long run. Think about the investor who sells a great company after it's up, say, 30% because they need to lock in the gain. Or the person who completely changes their investment strategy every 6 months because they read some article saying, I don't know, tech is out, energy is in.
So every time you jump ship.
Every time you switch strategies based on noise, every time you sell a good long-term holding prematurely because you're bored or anxious, you reset the compounding clock on that capital. It's a hard stop.
You lose all the momentum.
You lose the momentum, you lose the benefit of time working exponentially for you. It's like, imagine trying to boil water. If you keep turning the heat off just before it hits boiling point.
It never boils. You waste all that energy.
Precisely. You lose that stored energy, and you have to start over practically from scratch. Compounding's real power, the magic, is in that final exponential kick upwards. Impatience pulls the plug right before the big payoff.
Okay, so wealth building is fundamentally a psychological game. It's about waiting.
A game of waiting.
But waiting. Especially those early years when the numbers look kind of pathetic, let's be honest.
Yeah.
It must feel unbearable if you don't have some kind of strong guiding philosophy behind it.
That's the void. That lack of a why, a philosophical structure, is the chasm people fall into. If you don't truly understand why you're waiting, if you haven't internalized the physics of compounding, the waiting doesn't feel like discipline.
It feels like stagnation, like you're falling behind.
Exactly. You feel like you're missing out, getting left behind. And that anxiety, that boredom, it pushes people away from genuine long-term investing and straight towards gambling or high-risk speculation.
Because that provides the thrill, the quick feedback.
It provides the illusion of progress, the quick feedback loop, the immediate dopamine hit from a single bet paying off. That's what the impatient brain craves, even though mathematically the long-term odds in pure gambling are terrible.
It's a powerful distraction from the quiet work of actually saving and investing productively.
And that thrill, that need for action, it's always tied to information. Or maybe the illusion of information.
Yeah.
Which leads us neatly into the second big barrier.
Which is?
How we consume and process all the financial noise out there. The illusion of knowledge.
Okay, this one might sting a bit. Here's a brutal truth.
Usually fear or its cousin, anxiety, or maybe irrational excitement, FOMO, those are the levers they pull.
And emotion is basically the enemy of good judgment, especially with money.
Without question. If you're making an investment decision based on the fear that some talking head just screamed the market's about to crash, or the excitement because a Reddit thread says some stock is going to the moon,
you're not investing anymore.
You're reacting. You're reacting to manipulative noise, not analyzing fundamentals.
So what's the alternative? You can't just ignore everything, can you?
The key insight here is realizing what you don't need to know versus what you do. You actually don't need to know what the Dow Jones will do next month or what the Fed share is going to hint at next quarter. That kind of granular, time-sensitive stuff, it's almost entirely irrelevant if your time horizon is, say, 30 years.
So what do you need to know?
You need to understand consistent business fundamentals, how good companies make money and sustain advantages. And maybe even more importantly, you need to understand consistent human behavior.
Because that doesn't change.
Because greed today, fear today, impatience today, they are the exact same forces that drove markets 50 years ago, 100 years ago. That knowledge is timeless. The daily news is disposable.
This connects perfectly to that Munger quote, doesn't it? The one about explaining an investment.
The litmus test, yeah. If you can't explain why you're making an investment in one sentence that a child can understand, you don't really understand it yourself.
Think about how profound that is. He's saying strip away all the jargon, all the noise, all the complex models,
Nice thing.
and boil down your conviction to one simple, fundamental truth.
And most people fail this test instantly. They might be able to parrot back some complicated points from an analyst report about, I don't know, debt covenants or a new tech patent.
Sure.
But if you ask them the core reason, the why will this business be worth significantly more in 10 years? They often can't give you a simple answer. They start hand-waving or just repeating what someone else said.
So they're buying based on the article or a friend's hot tip or just pure FOMO.
Right. It's imitation, not investigation. It's not investing. And here's the really interesting psychological twist. This imitation, while it might be financially fatal in the long run,
It feels safe.
it feels incredibly safe socially.
How so?
Well, think about it. When you buy the stock or the crypto that everyone in your office or all over your social media feed is talking about, even if deep down you suspect it might be irrational, you feel this sense of comfort, belonging.
You're part of the group.
You're protected by the herd. And psychologically, it feels fundamentally better, neurologically safer,
Yeah.
to fail conventionally, right? To lose money along with everyone else when the bubble eventually pops.
Then to succeed unconventionally.
Than to succeed unconventionally, meaning being the rational outlier who sat out the mania and maybe looked foolish for a while but was right in the end. Succeeding alone feels isolating. Failing together feels communal.
Wow. So the psychological need for comfort and acceptance can actually override the desire for truth and financial success.
I think that's exactly what the sources suggest. It explains why entire crowds of highly intelligent, highly educated people can collectively lose staggering amounts of money in these speculative manias again and again.
They're choosing social safety over rational judgment.
They're sacrificing personal, rational analysis for the comfort blanket of groupthink, applied directly to their life savings, prioritizing fitting in over actually building long-term security.
And that constant looking over your shoulder, comparing yourself to the group, feeling like you're missing out when others seem to be winning, that leads straight into the third barrier, doesn't it?
The one Munger apparently despised the most.
The virus of envy.
Yeah, according to the framework we're exploring, envy is seen as perhaps the most destructive, the most toxic financial emotion there is.
Why specifically envy? More than fear or greed.
Because it's purely relative and purely negative. It blinds rational thought, but more than that, it replaces any potential contentment you might have with active resentment. It doesn't just make you want more, it makes you begrudge what others have.
And the triggers are just everywhere now, aren't they?
Absolutely constant. You see an acquaintance posting photos from some lavish vacation, probably funded by debt, but you don't see that part. Or a friend rolls up in a brand new leased luxury SUV.
Or the classic screenshot on social media of some
Yeah.
huge overnight crypto gain.
Right. And instantly, your own quiet, steady progress, those years of disciplined saving, the slow compounding you've been carefully nurturing, it suddenly feels totally meaningless. Pathetic even, like you're crawling while everyone else is flying.
That's the insidious part of envy, isn't it? It tricks you. It makes you want to abandon your own plan
Your own rational, personal, long-term plan.
for somebody else's highlight reel, which is probably curated, maybe even fake.
Often dishonest, yeah. It creates this intense internal pressure to keep up with an external image, a narrative that might be completely disconnected from reality.
And this poison, it feeds directly into bad spending habits, right? Consumer behavior.
Directly. The sources really emphasize this. Most people don't go broke buying necessities. They go broke buying things that signal status.
Keeping up with the Joneses.
Exactly. They end up measuring their own success not by their quiet, growing net worth, the number in their investment account that nobody else sees, but by how well they can mimic the flashy, visible lifestyles of the people they secretly envy.
They're trading future freedom for looking good right now.
Trading substantive wealth for superficial approval.
Let's break down the actual cost of that status signaling. Because it's not trivial, is it?
It's immense. Think about it. If you're buying, say, a $60,000 SUV on a lease, not because you genuinely need that vehicle for your family or work, but mostly because your neighbor just got one and you feel inadequate.
You've made a huge financial misstep.
You've fundamentally chosen external validation over capital efficiency. That money, the down payment, the huge monthly payments, could have been invested, compounding. This relentless status chasing is what keeps people trapped on the hamster wheel, running faster and faster just to maintain appearances, never actually getting ahead.
So envy is expensive. Literally.
Fundamentally expensive. It pressures you into making behavioral mistakes at exactly the wrong moments. We can probably group the costs into, say, 3 main destructive patterns.
Okay, what's the first?
First, envy pushes you to consume when you should be investing. All those status goods, the designer clothes you don't need, the house that's bigger than necessary, the constant high-end restaurant meals, they just eat up capital. Capital that should be working for you. That's the huge opportunity cost of trying to look rich.
Makes sense. What's the second pattern?
Second, envy compels you to react when you should be observing. You see someone else hit it big on some speculative bet. Envy screams at you to jump in, find the next hot thing right now.
So you abandon your strategy.
You abandon your core long-term strategy. You end up buying high on whatever trend is peaking purely out of FOMO, instead of calmly observing market cycles and maybe buying valuable assets when they're out of favor, when they're low.
Okay, consume instead of invest, react instead of observe. And the third?
Third, and this is maybe the most insidious, envy forces you to compete when you should be learning. Instead of spending your time and mental energy studying successful businesses, understanding economic history, or developing valuable skills,
You're focused on your neighbor's car.
you're focused on competing with your peers' perceived standard of living. You're benchmarking against their consumption, not your own progress. This diversion of resources, mental, emotional, financial, away from personal growth and towards social competition, it's a guaranteed path to mediocrity, or worse.
It really boils down to one critical idea, doesn't it? A maxim for anyone serious about accumulation.
Which is,
You absolutely cannot build significant wealth while you are actively trying to look wealthy.
they are mutually exclusive goals, especially early on.
Why? Especially early on.
Because in those critical first 10, 15 years, compounding needs every single spare dollar you can feed it. That's when the foundation is laid. If you're diverting those dollars to status symbols instead, you cripple the whole long-term process.
So the people who actually succeed long-term, the real masters of money, they understand this trade-off instinctively.
It seems so. They view their time and the power of compounding over that time as their most valuable currencies. They spend their energy accumulating knowledge, strengthening their rational philosophy, maybe reading Munger,
Right.
and just quietly accumulating assets. They are not chasing likes or approval from people they don't even know on social media. Their focus is internal, on the balance sheet that actually matters, not external, on the status signals that just distract.
And that intense focus,
Yeah.
the focus on the long, slow, quiet passage of time. That brings us perfectly to the fourth and final psychological barrier, which is all about perspective, really.
The failure to think long-term.
When you really drill down, analyze the core difference between people who achieve genuine, lasting wealth and, well, almost everyone else. It's rarely about some secret opportunity they had
Yeah.
or exclusive information.
It's usually not about being smarter, even.
Right. Instead, the sources suggest it's their psychological ability to access and operate within a really, really long time horizon.
They think in decades.
Decades, 20, 30, maybe even 50 years out. Not days, not weeks, not even fiscal quarters.
Yeah.
Decades.
And extending your time horizon like that, it's actually the ultimate simplification tool in finance. It cuts through so much complexity.
How did it simplify things?
Well, if you know with deep conviction that you're holding a particular diverse portfolio or sticking to a specific saving strategy for the next 20 or 30 years, your decisions become vastly simpler and usually much smarter.
Because you stop worrying about the daily noise.
Exactly. So you stop caring about the day-to-day market swings, the political headlines, what the Fed might or might not do next month. All that stuff becomes irrelevant noise.
So what do you care about?
You start caring only about the big picture, the ultimate structural direction of the underlying businesses or economies you're invested in, long-term demographics, fundamental economic stability, the stuff that actually matters over decades.
It basically filters out, what, 99% of the financial media?
Yeah.
Which is all geared towards the short term anyway.
Precisely. It's designed for traders, not long-term accumulators. The wealthy, or those who think like them, consistently apply what we could call the 10-year question.
What's that?
Before making a significant decision, an investment, a major purchase, maybe even a career change, they ask, will this decision still make fundamental sense 10 years from now?
And most people just don't ask that question.
Almost never. They live reactively, making decisions based on how they feel today, based on fleeting social trends or the immediate fear of loss or the desire for instant gratification.
They're trying to optimize for today, not for the decade.
Right. They're constantly trying to arbitrage the short term, make a quick buck, which almost always fails over time, instead of just positioning themselves to capture the slow, almost inevitable momentum of the long term.
And The market, or just reality, is pretty ruthless in punishing that short-term focus.
Absolutely. Wealth rewards patience, it rewards endurance, and it harshly punishes emotional volatility and short-sightedness. The longer you can stretch your time horizon, the less you actually have to rely on luck or being some kind of investment genius.
Why is that?
Because compounding takes over the heavy lifting. You're just giving the mathematical engine the fuel it needs, which is time. Lots and lots of time.
So financial success becomes less about being brilliant, less about timing the market perfectly,
Less about clever stock picks.
and much more about just emotional endurance,
Yeah.
sticking with it.
Yeah. Your sheer ability to tolerate boredom and stay the course, if you simply give compounding enough time, the exponential growth it eventually generates will dwarf any early mistakes you made, or those initial years where it felt like nothing was happening. That long-term commitment itself becomes your most valuable asset,
And this leads us to what the sources call the great recurring tragedy in finance.
which is...
Most people quit. They give up right before the magic of compounding really kicks into high gear.
just when it's about to get interesting.
Exactly. They switch jobs and cash out their 401k. They change their investment strategy for the fifth time. They sell their holdings to buy a boat or remodel the kitchen. They never fully grasp that it's the time, not their talent or the initial speed, that creates the truly exponential, life-changing growth.
They get bored. They can't stand waiting for those seeds they planted years ago to finally sprout and grow into something substantial.
That inability to just tolerate the quiet, the sustained, often monotonous effort, that's the core failure, isn't it?
It really seems to be. Which brings us to that final analogy, which I think sums it all up perfectly. Building wealth.
Yeah.
It's not a sprint. It's not even really a marathon.
What is it then?
It's like planting a forest.
Planting a forest. Okay. Explain that.
Think about it. It requires enormous faith, right? You put in all this effort up front, preparing the ground, planting the saplings, nurturing them, protecting them.
And you see basically nothing for a long time.
Virtually no visible return for years, maybe decades. You have to give it years and years of quiet, patient, often unspectacular attention before it finally starts to show its true worth. Before those tiny saplings actually become a real self-sustaining forest canopy that provides shade, shelter, continuous value.
So the conclusion, tying all these psychological failures together, impatience, illusion of knowledge, envy, short-term thinking.
The conclusion is this. People fail to become wealthy, fundamentally, because they cannot endure the quiet. They need the noise. They need constant action, immediate feedback, excitement, to feel like something is happening, to feel validated.
But the masters, the ones who get it,
The few who really internalize these lessons from Munger, from history, from common sense, they understand that the silence, the quiet, the apparent lack of action, that's the essential environment where real, unstoppable, exponential growth actually happens.
Okay, let's quickly pull it all together. We've walked through these four huge internal psychological barriers that stop people from achieving sustained, rational financial behavior.
Right, we hit the cult of impatience, how it forces costly actions and just kills compounding.
Then the illusion of knowledge and mistaking emotional media noise for actual useful information.
Then the virus of envy, how it drives destructive spending and makes us compete instead of learn and save.
And finally, the failure to think long-term, quitting the game right before the exponential curve really takes off.
And the ultimate lesson threading through all of this, especially from that Munger-inspired perspective, it's actually pretty simple, isn't it?
What's the distillation?
Financial success is fundamentally about mastering your own mind, controlling your internal impulses. It requires maybe less complex financial engineering than people think.
And way more behavioral control.
Way more. It's an internal battle before it's an external one.
And that's the real relevance for you listening right now. Just knowing this stuff isn't enough, right? Knowledge is only valuable when you understand it deeply and then actually apply it.
Absolutely. Understanding these psychological traps, recognizing how the game is often rigged internally by our own predictable human nature, that's the absolutely crucial first step towards choosing and sticking with that boring, rational, decades-long path.
Because the tragic paradox we kept circling back to is that the very silence, the quiet patience required for wealth building, it looks and feels like stagnation.
So people abandon their single greatest asset, time, just because it doesn't feel exciting enough.
Okay, so we'll leave you with this final thought to chew on. Maybe apply it beyond just money. Think about your own life. What aspect? Maybe it's learning a new skill, nurturing an important relationship, pursuing a long-term career goal.
Hmm.
What part of your life are you maybe rushing right now?
Pushing too hard for immediate results.
Yeah, because you can't quite endure that quiet, seemingly unproductive, boring phase of accumulation or practice. That's probably where the real discipline needs to kick in.
And that's almost certainly where the true sustained growth eventually begins.